Good day, everyone. Well, we have a straight up from the bottom market. These bounces tend to be sharp. Bear market rallies tend to be this way. The question is, how far is this bounce going to go? Are we going to repeat October of last year, where it continued higher on waning leadership? Although I would argue that the bounce that we saw in January was the weakest we'd seen in 2012, and this current bounce may be a repeat of the weakness. The leadership is basically non-existent. We're seeing industry groups that are basically defensive in nature leading the way, and that does not bode well in general for the sustainability of this rally. We do see potential short sale setups emerging, and obviously we want to be very selective about which stocks that we're going to focus on, since short selling can be quite tricky. And in terms of the bullish arguments, well, you know, oil's bouncing here, and I guess the OPEC countries are coming to an agreement of the slowing production, or at least freezing production, not hiking it. That would further create a glut in the supply, and thus send the price of oil lower. But I would also argue that the general downtrend of commodities is very pronounced, and we're not out of the woods. I know some analysts are calling for a major bottom in oil now, a major bottom in the markets, but the technicals say otherwise. I think we're in the midst of a downtrend, and as long as the global economy remains in a quagmire, I don't think there's enough demand for oil and other commodities to start a real uptrend of any meaningful measure. So right now it's vigilant to just keep an eye on any short sale setups that do emerge. And of course, if you are playing the long side of the market, if you're playing a quick bounce, obviously be mindful to take profits where you have them, because again, these bounces can be quite short-lived. And now, also the one commodity very importantly is the gold and silver situation. Gold basically has been rising because of a lack of confidence in governments, and in a macro sense, we could see gold eventually start to gain some traction as confidence in central banks, the recessionary situation continues to loom, and that could send the price of gold higher. But for now, I mean, we have seen a nice spike to the upside, so we need to also be vigilant in terms of the technical action that may provide a good buy point going forward. That buy point may not come for another several weeks or even months, but one thing I like about the GLD ETF is that it tends to be quite clean in terms of its technicals. When there is a major buy signal, it shows up in the technicals, and this has been true since the early 2000s. But these major buy points are very, very rare. They happen maybe once every couple of years or a few years. So this current situation, you know, it's entirely possible that with all the central banks printing money, and should the Fed go to QE4 and adopt negative interest rates, that could sustain a fake out rally that is very lackluster. We could have another, well, hopefully not another 2015 on our hands, where the market just doesn't really want to move anywhere. But for now, the Fed is still leaning on the idea of, well, I guess now they've switched to a neutral stance and a wait-and-see attitude. So the markets have liked hearing that, and I suppose that's only one step away from the Fed entertaining the idea of going negative in terms of rates, even though that has not shown itself to be helpful whatsoever in restoring any kind of dignity to the economy. outside of that, there's really very little on the long side that looks playable here. It's a very tough market to make headway in. But right now, I would say that this current bounce could potentially become more suspect as soon as today and tomorrow, and that could lead the MDM to switch back to its sell signal. And with that, I'll turn it over to Gil.
Yeah, it looks today like we're running into resistance on the major indexes. The rally over the last 3 days has been very sharp, and we actually saw it on, I think that was Wednesday, or I think we went, or Thursday, I forget. What day was that? The MDM went to a neutral signal. We were talking that day, and we decided that the market looked like it was trying to create a bottom, right, Dr. K?
Right, so Thursday MDM went to its neutral cash signal.
Right, and the market was down, I believe, at the time. So that worked out pretty well. But you could see it with a lot of the short sale target stocks that I've been tracking down, way down in their patterns. And I track these things very closely because when you start to see that, and then the selling becomes obvious. I saw Market Watch, or I read Market Watch on Thursday night last week, a week ago, said that the Dow's downtrend is now official. And when it becomes that obvious, you got to be set for some sort of a bounce. So we get this very sharp bounce. You can see the Nasdaq undercut the mid-January low. I think this also coincides with the August low. So that set this rally up. It's very logical. But now you're coming up into overhead, and so I've got both eyes on my short sale watch list. Well, and maybe one eye, part of one eye at least, watching some of these longs as they pull back. I did go long a couple 3 days ago, and basically trading them out today when I saw everything sort of peter out. But it made sense to me that you get the follow-through day yesterday, and you could have called this a follow-through day, I guess. If you count this day here, let me use my pen, maybe make it a little bit easier. If you count this day here as your first rally day, so you're 1, 2, 3 here, and you're up on volume, but usually a third day follow through needs needs overwhelming power, and you haven't really gotten that. You got it more yesterday, and of course that brings IBD in with a follow through. But by that time, a lot of the things I've been buying are up 2, 3, 4, 5%, and I'm generally selling into that and waiting to see how the pullback handles itself. So today, what we're seeing is a pullback after we run into resistance. I would say is in between this area in here, and so you're in there now, and this may be where we turn lower, so you want to watch for a failure here. In most instances, when you get a follow-through day, it generally fails rather quickly, and I think we can go back to I think this was a follow-through day. Wasn't this a follow-through day here, Dr. K? That would have been end of January, right there. Nice arrow, huh? And then it failed within a couple of days when we went lower. So here we are, we're already failing, we're already turning lower on the first day, which doesn't look too good. So we'll just see how today plays out. The other thing I'd be keeping an eye on is my long watch list to see how things pull back into support. So, whoops, let's go to the S&P. Let's see. And you can see that it just barely undercut the mid-January low, and I think this also coincides. It's already been undercutting the lows back in August and September. So again, you definitely have the context for at least a short-term low and a reflex bounce. And when it's getting obvious, I think IBD went to a marketing correction right here or something. So, and all the way down here, they're in uptrend under pressure. But this is what really bothers me about these people all trying to tell you that we're in a bear market, or we're in bear market territory now, or we're in a marketing correction, or even when the market starts to bounce that you're in an uptrend under pressure. To me, it's all just a bunch of BS. And the reason why is because you see on the NYSE composite, which is a broader index, you actually topped back here in the middle of May. And you sloped down, you had one leg down, okay? And that ended with the big sell-off in August. You had a retest. And then you get into a choppy range. You could draw lines across here. Let's see, I'll pull out my annotation tools. Here they are. And you could draw a line, between here to here, and you got a nice bear flag, and it fails and it breaks down, breaks out here. And on the breakout, That was at the beginning of the year. That to me looked like a big short selling signal, and you just busted wide open. Now you've come down, and if you measure the down legs, maybe this has a little more to go, although you could say from here to here, here to here is a little bit longer, depending on where you measure the actual failure. And so you may have a little more downside from here, and if we fail here today, I think that's where you're headed. So one person saying they cannot hear. I'm assuming everybody else can hear. That's probably your own internet situation there, Al. So you might want to check that. But I can hear everything fine. I can hear Dr. K, and I'm assuming most everyone can hear me. But anyways,
Yeah, you're coming in fine.
yeah, you can see that we're in the second leg of a bear market that started in the middle of last year. And if we look at, say, the Russell 2000, same situation, although that topped in late June. And so one leg down here, and then you go into a choppy range from August through the end of the year, and then you break out to the downside, and kaboom, you get slammed. And that's a huge break from that point. And now we're chopping around along the lows. So are you starting a bold new bull market phase? I don't think so. There aren't a lot of things in position. I think at best you're looking at trades. Let me go through some of those. I'm just going to bring up my watch list up here. This actually I think is a short. Let's pop this over here and pop this down a little bit. Tesla at the 20-day looks like a short, but you know, Facebook trying to come out, trying to hold the 50-day. How it pulls back, volume I think is running at, let's check this out for a second here. Let me put my volume levels up here so I can see. We're running 35%. So you're not, volume is running about 35%, 29% above average right now as we come into the 50-day. So it's not drawing up, okay? That's probably an issue. So what I want to see is maybe later in the day it starts to dry up, but we'll see how this plays out. You know, McDonald's is another one trying to hold along the 50-day, but both of these could easily morph back into shorts. So that's something to watch out for. I was keeping an eye, or actually I was long Facebook and McDonald's and SolarEdge overnight, and they opened up slightly, and I actually it just kind of wobbled, and then I said goodbye, and I tossed them and got out with some profits on the long side over the last 2-3 days. So you can see this is failing now. SunPower came out with earnings yesterday, and this is failing at the 50-day. That becomes a short. First Solar reversing at the 50-day, that becomes a short. And I think we talked about this as being a potential, we blow it up, double pod type formation. You see the breakout attempt here through the top of this pod and actually pushing up to the highs of this pod. So here's one pod, here's the second pod, and you're failing now. So now this comes into the 58, and had it rallied above and you saw volume picking up and very strong, then I would look at going long. You know, and I was long First Solar yesterday, playing the pop up to the 50-day. That was a trade. I stayed long SolarEdge overnight, and that opened up and let me get out. SunPower also opened up, as you can see on the daily chart here, but it's reversed, and that's bearish. So now this group, which was on my buy watch list, now becomes one of my primary short sale targets. So I go from long to short on the same names on a moment's notice as soon as I see the evidence in real time tell me to do that. And I don't have any bias. You know, a lot of people, the market's rallying for 3 days, and the whole way up they want to just keep shorting it, and shorting it. My experience is that if you just sit and wait, and you have a reasonable short sale watch list of maybe 40 to 60 names, just sit and wait, and you're going to see something in the next couple, 3 days set up perfectly. And you just wait for that. And so if you have a lot of names, you're going to find at least a handful. So this morning, you know, Tesla runs into the 20-day. You got First Solar runs into the 50-day. I'm short that. Nike is rallying up into the confluence of the 20-day and the 200-day. Microchip, this is another one I'm short. It's sort of failing around the 20-day. This one's weaker than, say, Linear, although Linear Technology is above the 200-day. I'd like to see it bust. Let's see. Amazon Did I show that one already? At the 20-day, so I'm actually short that right at the 200-day rather, and the 20-day. So you can see all of these are in perfect positions. If you tried to short down in here along the 10-day, yeah, you might have gotten an intraday reversal here. You can see on the price range it hits the 10-day and then closes lower than where it opened and well below the 10-day line, well, reasonably well below. But the real juicy spot occurs when it gets to the 200-day. So you kind of have to lay back and just let them come to you. A lot of people will get real stubborn and they want to keep shorting and shorting. And one of the things I've learned, and I'm going to say after many, many years of trial and error and learning from my mistakes, one thing I've been able to learn and internalize is this idea of not becoming rigidly bearish into a rally, and just kind of backing off, and also getting a sense of when you've just had a nice piggy run on the downside and you're making some nice profits. And I notice a lot of the people I talk to out there from emails and blog posts and Twitter, that they also, who are, if they're shorting, they have a pretty good sense of this. So what it tells me is the new book has positively impacted people's ability to understand the short side better. So, I mean, other names I've been looking at on the long side, here's Cree. This is a turnaround play. This is what it looks like on a weekly, but earnings are expected to turn around to triple digits 2 quarters out. But you can see that broke out, it's coming in. You see the gold and silver stocks moving again because gold is moving. This is, I mean, you can make the case that it's a safe haven type of play, and I thought that was the case, but what it may be telling you as well is that you look at the dollar, for example. Dollar's been coming down hard in February, and I think it's because the Fed is now going to be sitting tight, not raising rates, and that's what that's telling you. Even though Yellen's testimony last week was seen as hawkish, the dollar reacted by reversing and heading lower, which I thought was interesting. So that kind of told you the real story. And gold is holding up pretty well, pulling into the 10-day. Does that become viable? Maybe. Silver into the 10-day, also the 200-day. Does that become viable? Maybe. The only thing is if we get into a real bad market and you start seeing more forced liquidation, this is something I've talked about in prior webinars, they're going to take everything down eventually. But in the meantime, you can try and trade the gold thing. I've actually been playing it both ways, long and short, because you can see there's a fair bit of volatility in not only the metals, but you look at AEM, for example, NEM. But it's typical of a scalper's mentality in this market so far. But we may be getting a nice shorting opportunity here if things continue to break down. So let's look through. I posted, I think, what is my entire short sale watch list here. So what we're going to do is we're going to go through all these names and see where they're sitting right now. So you got Apple, rallies and fills this gap here, and looks like it's reversing. Busts the 20-day, the green line here. Short using either the high of the day or the 20-day line as a tight stop. I already told you we're short Amazon at the 200-day. Baidu, and kind of in no man's land, but notice how it rallies up into this area of congestion. Facebook may become shortable again. I'm watching to see if it busts the 50-day. What I should have done is when I sold it this morning when it was up close to 106, I should have flipped and gone short. So I did that with other names, but not this one. Google reversing at the 20-day, so potentially shortable using the 20-day as your guide for a stop. You can see on the weekly chart, let's see if I can make this bigger for you, and you have to be watching these on the weekly. One of the things I like about HGS Investor software is that it allows me to create a list of my short sale watch list, which is here, and I have all the moving averages posted here. So I can, as I'm updating this intraday, I can quickly scan across my list and see what is sitting close to a moving average or approaching a moving average. Now this is for the more technically minded, okay? I just will flip through my short sale watch list like this. Boom. Come on, baby. There we go, like this. I do it visually, but you know, if you need to look at a table, maybe that helps. Anyways, let's keep going. Intel shortable probably at the 20-day line. You can see that. Microsoft pushing up into the 50-day line and reversing, so that looks shortable using the 50-day line as a quick stop. Netflix reversing at the 20-day line. And remember, for anybody who's read the new short selling book, the 20-day moving average, exponential moving average, and you could probably use like the 20-day simple or 21-day or 19-day or whatever. They're roughly the same. And remember, I don't view moving averages as solid lines. I view them as the center of a fuzzy sort of quantum zone, if you want to call it that. Am I using that term correctly, Dr. K?
Sorry, what did you say?
When I refer to a moving average as not a solid line, but sort of the center of a fuzzy quantum zone, am I using that terminology correctly?
Well, yeah. Basically, well, moving average line is quantum, it's discrete. But of course, as we all know, the actual proper moving average line is fuzzy because it depends on a person's trading personality and also being able to create rules around that particular moving average that work for them.
Indeed. So, like I said, the 19-day, 21-day, whatever, simple, exponential, whatever, it's roughly the same. So you get a sense, because you can see a lot of these names, like Netflix, it's reversing around the 20-day. So I'm sure if you did a 18 or 22-day line, it would be perfect, but you can't fit the moving averages. Just understand that it's just a fuzzy zone. So you're looking for action around the moving average. And that's why Dr. K refers to porosity or the movement just beyond, like price line going just beyond the 200-day line. That's an example of porosity up through the 200-day line. And this could just roll over, and that may put you in a very nice short sale spot. Look at this thing. It's come on the weekly chart, it's come all the way up to here. So in my view, this is in a shortable position, okay? And your stop's pretty simple. Use the high of the day at 1250 as your stop. And it's a big stock, so you can short 500 shares and be short $500,000 worth of stock. I like that. I like 1 or 2 click stocks where I can buy and sell 5 or 10,000 very quickly. Let's continue down. We already went through Tesla. Expedia failing at the 50-day. So you already can see, and we've only gone through a few names. Look at CRM, Salesforce failing at the 20-day. So I see this all happening at once, and so it tells me, based on the action of the stocks, that we may be at an inflection point. Now, if some of these things can blast through the moving averages and the volume is very heavy, as opposed to the volume picking up here and the stocks all reversing at the moving averages, then that would be bullish. But the action we're seeing today is very bearish. So I can assess this based solely on the stocks themselves. I don't need to worry about the indexes. I don't need to worry about follow-through days. All of that just becomes moot as I focus on the action of the stocks themselves. And watching lists of stocks is very useful, and particularly once I've built a pretty decent-sized short sale list in an extended bear market, it really helps show you where you're at, really. Because as Dr. K was pointing out, even with the follow-through day, there isn't anything really in viable position. There are a few things, like Smith Wesson, Hawaiian Airlines, I think is one. Maybe the Cree, but for the most part, it's pretty scant out there on the long side in terms of actionable setups. But what you are seeing here is a lot of stuff on the short side come back into focus, and that's telling you that we're probably at a spot where we're going to roll over, and so you want to be in position for that. So let's keep going. Love, not quite there. I'd like to see it at the 200-day moving average. Palo Alto Networks, it's so weak it reverses at the 10-day line. But my theory with some of these stocks like Palo Alto Networks, and you can throw in a bunch of others, Tesla being among them, LinkedIn, is that they're high PE stocks, and we're in a contractionary PE environment where the market is not interested in infinite PE stocks or high PE stocks. So even if you are going to try and test the long side, I'm looking at things that have reasonable PEG ratios, price to earnings growth rates, or are selling at valuations that might be less inclined to persuade institutions to unload them in a weak market, because institutions know that when something is valued at a bazillion times its real value, they're looking at things in a much more tangible manner when they try to survive a market downturn. So anything with a high PE or an infinite PE, it's just going to get raked, and there's no reason to try and screw around with them on the long side. Like trying to buy into stuff like Square, because Visa is going to buy a 1% position, which amounts to about 300,000 shares, or any of these other junky things. Palo Alto Networks, LinkedIn, that's a high PE stock. Notice how it's coming up into the 10-day. If it got up close to this high, 128.99, that would probably make it very shortable. But notice how it's running right into the 10-day. So very weak because it's a high PE stock. Tesla getting as high as a 20-day today, but it's so far down in its pattern, everything's starting to look like up. So it just reverses at the 20-day. Get back to Palo Alto Networks. Disney, as I like to call it, dismal. Yeah, trying to rally into resistance around the 20-day. Maybe it fails. What are we down? We're down 45 on the Dow, S&P down 940, Nasdaq down the most 33.44. So you're seeing that the bigger cap stocks on the Dow and the S&P probably are keeping those from busting wide open. And there's a movement towards more tangible value, if you think of it that way. Celgene possibly at an area of resistance. If we look at the weekly chart, it's getting pretty close to the 10-week line. But that's why I was pointing out on, I got sidetracked there, is on Microsoft, you can see it's right into the 10-week line. So you want to be watching both of these, and that's why I have a daily chart and a weekly chart. So ideally I set them up like this. And we can hop and bop through them like this. See, I can see the daily, I see the weekly, and that's what I like to do to get a good sense of where everything is. And if something is sitting at a juicy spot, we come after it. So there's Starbucks right into the 200-day line and right into the 40-week line. So that might be shortable. And you can see that's a failure there. So market's trying to bounce its way back, flopping around like a dead fish or a barely alive fish on the deck. You see Panera here. Now this is interesting because you're breaking the 200-day line, or I'm sorry, the 200 price level for the second time. The first time it failed. So that was a 200-day century mark or $200 century mark failure, and that could have been shorted, and things blew apart. And it came out with earnings recently and have rallied, or has rallied above the $200 level on heavy volume last week. So now what I'm watching for is if it fails. See, I would have bought this on Tuesday, right at around 200, with the idea that it's a long play using Livermore's century mark rule initially, and you play it that way until evidence proves otherwise, at which point if it fails at the $200 price level, it morphs into a Jesse Livermore century mark rule in reverse short sale. So where are we? There we go. AYI, Avago failing at the 200-day line. So there you go. There's another one. Visa sitting at the 20-day line. These are old shorts. CCL at the 20-day line. Carnival. Microchip at the 20-day line. I'm short that actually. It's coming in a little bit. Illumina at the 20-day line. Home Depot at the 20-day line. These are all recent failures. Hanes Brands rallying up to the 20-day line after a big gap down. That looks like it's in a shortable position. You also see that yesterday, this thing on the weekly chart, you can see that it got to the 10-week line over here. Let's keep going. Nike rallying into the 20-day. That's a short. I'm actually shorting that right in here. Have been. McDonald's may be failing. And notice how volume picked up yesterday, but it seemed to get support along the line. And I think you're holding just above the 10-week line. It's possible this could become shortable here. And I was long this thing. Yesterday I had a nice pullback, and I got pretty heavy long the stock, like 50-60% position, and wrote it up and then sold it this morning. Amazon we looked at. UA, kind of in no man's land here. Kind of watch that one. Ulta, this one rallied up to the 10-day and failed at the 10-day, and now it's gapping to lower lows. Lululemon has rallied up above the 10-day. Notice so it's beyond the 40-week line here, but you rallied into the underside of the base here, so that becomes a potential short sale point. I think I may have talked about this a couple of weeks ago because this is an area of overhead price congestion, and so you would look at this as potentially being shortable on this rally, but you're kind of in the middle of the 10-day line and the prior high, so it's not really clear. Maybe you short it here, use the high of the day and look for it to break, but there's probably other things. Well, we already know, having gone through most of my short sale watch list, that there are a lot of other things. So look at First Solar failing at the 50-day, it looks like. I'm short that. BlackRock, financial stock, with they're an investment manager, but they've been reported to have big holdings in oil bonds, which could be problematic for them. They're sitting at the 50 days. Skyworks Solutions at the 20-day. NXPI at the 20-day. Biogen at the 20-day. Microchip at the 20-day. Linear just above the 200-day. We were looking at this earlier. Maybe it busts back through it. Walmart gapping down off the 200-day. I thought this had a shot at maybe going a little higher. Maybe it would get up to this area of congestion, but it never really cleared these prior highs and just came down. So my original short sale thesis on this thing was correct, but it was starting to look like it wanted to maybe pop above. And if the market kept rallying, it probably would have. But in this case, it gaps down, and that could be viewed as a shortable gap down using the high of the day at 63.89 as a stop. That's about $1 away. So it's 1.5%, maybe less than 2% away. So that's reasonable. And if you short it here and it rallies a little bit back, you do a partial position and add if it goes through. But notice another thing, it's below the 50-day now. So that is at 62.87, and that's a dime above where it's trading right now. So that could be an even tighter stop. So, but this looks like trouble. One moment, please. I think I'm just going to try this. I'm just going to short a small position, 2,500 shares here on Walmart, just to test this out. I'm going to use a 50-day as my stop roughly, maybe give it another couple of dimes. We'll see, based on how it feels. But so there's a real-time short. I think a couple of weeks ago I did Workday, if you guys remember. Go back 2 webinars ago, and I was shorting it here near the 10-day line, and kaboom, that became a gooey kablooey, came apart over the next few days. That was when data came out with earnings and gap down. So and this thing looks like if the high here is 45.64, either it runs into the 10-day or it's just forming a tight bear flag. And this is a bear flag, and the tightness now works against it. Follow me? So essentially, it's like it's the same thing on the upside. If this was a gap up move and it's holding tight and drifting down, so if you flip this over and look at it in a mirror, it'd look like a gap up move with the base drifting slightly downward, very tight as volume dries up. This is negative. It probably means this turkey's going lower. And I think this thing, even at $44, 41, 42, or $3, whatever, it trades at about 120 times forward estimate. So again, get back to this idea I've been talking about, where we're in a market environment that is not going to be forgiving to high PE or infinite PE stocks, and we're in a contracting PE environment. So you want to think about that also when you're shorting stocks. Let's keep going and get this finished up here. Walmart, US Bank. I think the banks look like shakeouts plus 3 type setups. They're coming in. I think the volume's lighter here. Let me take a look at this. USB. Whoops. No, not FB. USB. Running. Volume's minus 18.8%. So my view is that on these financials, things could get nasty for them because there's a couple of things working against them. Number one, the fact that interest rates are going to stay low. Notice how back when the Fed raised in December, I think banks started to rally. Let me take a look at that. December, here. Yeah, they rallied. Like here's US Bank. After the Fed meeting, they rallied because the Fed raised interest rates by, what was it, a quarter point, Dr. K? I think so. And it looked like it's going to break out, and you could do the XLF here as well. And basically, it rallied up at that time. But then they realized that it's probably one and done. And the true interest rate environment going forward, which in my view is probably arguing for QE4, negative, NERP interest rates, that's what's causing the sell-off, and it's exacerbated by the financial system's exposure to potentially bad oil industry debt. So I think there's a double whammy there. And so these, if they reverse, I think they become very shortable. So US Bank, finds resistance near the 50-day, which is right at the 10-week line. Goldman Sachs finds resistance at the 20-day. So this is actually looking pretty grim. Look at that. Remind you of 2008? I think so. Morgan Stanley finding resistance along the 20-day line. So, look at that. Tell me something isn't wrong. And I don't really understand, and this is why I oftentimes don't understand what's going on over at IUD, probably because Bill O'Neill is no longer really in the picture. And so you just have a bunch of guys running things who are just parroting things they read from his book. And the guys who really know what they're doing, like Lee and Charles and everything, they're too busy running money. So, but how you can say the market, even on a blip like this, where you see the financial just busting apart, how you can consider the market to be anything more than a short-term long trade when it bounces? You know, I don't understand how you can call it an uptrend of any kind. And we see that also in the...
Yeah, you know,
Go ahead.
there's also the issue that if you look at the Deutsche Bank, you know, that's the big old bank in Europe, the German bank, and that's trading below its lows of 2008. I don't understand how that doesn't scream. There's a serious banking crisis going on in Europe, and the euro cannot withstand another banking crisis. And I think it's you know, it's a matter of maybe a year, maybe 2 years, and the euro will break down. And you don't have to even look. You can look at Credit Suisse too. The giant Credit Suisse is also flirting with. No, it actually has penetrated. That is actually also trading below 2008 lows.
Yeah, you're right.
These European banks are having a horrible time, and the central banks are not. Well, what they're doing is they're trying to put Band-Aid for a very infected situation. And and you can also argue that they're adding fuel to, they're adding gasoline to the fire, basically, by continuing to ease rates and go negative. So this bubble that is being created by governments around the world is potentially more disastrous than what we saw in 2008. It's just a question of when that's going to occur, and again, I think it's going to occur sooner than people do think. 2008 did come as a surprise to most of the world, and I think this time will be no different.
Yeah, and I don't understand how anybody can really get all that positive on the market and fool yourself into thinking that there's potential for an uptrend. I'm always willing to play sharp short-term bounces on the long side when I can find them, and a lot of times in this market what I've been doing is using the undercut and rally type setup, which is a derivative, I guess, of Livermore's shakeout plus X or whatever, to go long certain stocks, you know, or pick up something I was short, pick it up long or flip long rather when it undercuts a big low or when it does something. An example would be, you know, Facebook. If I get short up in here as it busts 110. It breaks down, it undercuts, or it actually undercuts the low of the gap up window. So this is a rising window. The lows of the windows, maybe we could call it the window sill, right here, it undercuts. So when I see that, I'm going to cover. And then sometimes it's possible to flip and go long. I didn't do that in this case. I waited, I went long this thing 3 days ago. I guess, what's today? Thursday? Wednesday? So I went long it here on Tuesday. Was it Tuesday? One of those days. In any case, stock went up, you know, gave me about 4 or 5%. I took it, and I think I had a 60% position when I jumped into it. So that, you know, a 60% position times a 4%, that's going to give you about 2.5% to your overall portfolio. So you can pick up 3, 4, 5%. So if you can operate this way, you make a bunch of money short, and then you know when to flip long for a quick trade. You can pick up another 2, 3% in your portfolio, and you're just pyramiding that and compounding it rather. So anyways, let's get to some questions. Okay, good to know you fix your speakers there, Al. Get some new speakers, will you? Someone's asked about Avago. I think I went through that already. You're reversing at the 200-day line. So 200-day line's at 129.45. You're trading at 128.57. So you could short it using the line as your guide for a quick stop, or the high of the day, which is 131.99 as a tight stop. That's about 2% away, 2-3. Let's see. From your studies of Jesse Livermore, do you think he would become a boy plunger into the capitulation last week? How do you think he would handle these trades? I have no idea. So unless we can do a seance and conjure up the ghost of Jesse Livermore, I have no idea. What we do know, and I think everybody knows as much about Jesse Livermore as I do if you've read all the books about him, is that he didn't use Can Slim. He didn't buy breakouts. He looked for pivotal points. And that's why the pocket pivot works, is that's a pivotal point. There are other undercuts. Undercut and rally is a pivotal point. And you can study Wyckoff in this regard, the springboard, I think it's called, when you get an undercut. or Wyckoffean low, as I call it. That's a term I made up, which is when you retest the low on lighter volume. So the selling dries up as you retest the low. I think that's also part of what's known as volume price analysis, or VPA. And you could read Anna Couling's books on those. I think it's Coulling. Anna Cooling. She wrote some books on volume price analysis. But it's very similar to what I do, the voodoo concept on a pullback, stuff like that. So, there are a lot of different ways to determine buy points if you're open to them and you can see the action in real time. So as you put in screen time, watching the tape, these days, back in Livermore's days, he's looking at the tape and discerning what was going on by what he could see on the tape. Today you're looking at a screen with 100 different little blinking lights all flashing at you all, nonstop. But you are sensing the rhythm and the flow of things if you organize your screen based on what you're looking at. So if I have my whole short sale list here, I can see what's going on. Mostly it looks pretty red. But of course, looking at the ones that are up might give me something I want to short. So real quickly, you just pop through, and Microsoft looks shortable using the 50-day. That's only about 60, 70 cents away. So that's pretty much in range. Market's popping around all over the place. So what's volume looking like, Dr. K? Are we up? Looks like volume is actually down. So the pullback is on lighter volume. So, maybe that it is short-lived, but I think it's logical after 3 days up. But you can get a sense of how if you lay back on the short side, just wait for things to come at you. Now, where were we? Oh, yeah. So I don't know how Jesse Livermore would handle these markets. He probably would have shot himself again. So because it's that difficult, and probably even weirder than it was when he was trading it. So Morgan Stanley strategist just told everyone to do the opposite of what he has been saying. Okay, maybe that works. So Morgan Stanley strategist is admitting that he has no clue either. And, the market's kind of become like that. But I think, as Dr. K and I were discussing before the webinar, you may be at a tipping point with respect to major change in the financial systems and the social systems, the governmental systems on the planet, because of just how bad a situation we're in with respect to all the debt around the globe. And it's pretty pathetic when you stop and look at it. $19 trillion in the U.S., and yet Bernie Sanders is, I saw the poll came out this morning, I think it was a CBS poll or a Wall Street Journal poll, where he actually beats all the Republican candidates. Well, Hillary loses to every Republican candidate except Donald Trump. Of course, that's just a poll. But it sort of tells you where we're at and how stupid people are, because if they think socialism is the answer, it's basically spending money to give everything away to everybody for free. And if you have the money to do it, great, it might last for a while. But what if you start with socialism when you have no money left and you're $19 trillion on a cash basis in debt, as the U.S. is? And the U.S. really, when you count in all of the future obligations, as any real company would do using GAAP accounting principles, everything would be done on an accrual basis. And the U.S. is well over $100 trillion in debt in terms of its total obligations, present and future. And that's the reality of the situation. And where does that money come from? $100 trillion. You can take all the wealth from all the top 5% or 10%, and I think you don't even get close to even a fraction of that. You know anything about those numbers, Dr. K? If you confiscated the wealth of the top 5 wealthiest people in the country, would you?
If the government were to do a complete manhunt and confiscate the wealth of the top 1%, it would still be a drop in the bucket. It would be a grain of sand.
Right.
So what the government is doing, consequently, is going on a manhunt for taxes across the board, basically trying to get the middle class, because that is the sweet spot. The middle class represents the majority of people with money as an aggregate. And that is why they are slowly and surely devouring their middle classes with various fiscal laws that are being put into place. And by the way, it's not a war on terror. It never was. A lot of these things have been staged. I think that's being proven out now in the alternative media. But what it is a war on taxes, and that the governments are basically in unison on this. I mean, you don't have to look far. Go to the internet. I always tell people who are looking at the shell shock, they said, look, don't take my word for it. Go to Google and type in these keywords and look for yourself. Do your own research and due diligence on what's going on in the world, and you will be in for a nasty surprise. Because it's not just the U.S., UK, Europe. It's Australia. It's New Zealand. It's Latin America. You know, it is trying times. I'm in Buenos Aires right now, and it is shocking. They're going through hyperinflation, and of course, it's not even being reported. It's just talking about bad inflation. But in the last month, the currency has depreciated almost 15% to the dollar in 1 month. And if you go around the streets, we're in the nicest part, Palermo. But if you go around in the businesses, 1/3 of the businesses are not in operation. And if you go to some of the nicest restaurants, and they're beautiful restaurants here, they're offering 40% discounts because people are just not going. They don't have the money. And yet, it's a crisis situation, not just here. You know, it's tough to get money out of ATMs. A lot of ATMs run out of money, believe it or not, at the airport when we landed. None of the 5 ATMs worked, the different 5 banks. And I think it's a reflection of what is going on around the world right now. And so, you know, these are fascinating times to live in. I guess that's the best word, because Ed Seykota book, Gavopoly, doesn't talk about despairing and throwing in the towel and giving up. He talks about keeping a clear head and focusing on the next opportunity, because we are going to have some major opportunities coming our way that are probably going to be quite volatile.
I agree wholeheartedly. So, and you know, right now it looks like the short side is. I've been working at. I'm up to a pretty good size position in short in Nike. It's starting to roll over. Now let's look at in real time. You know, I put a little bit of the Walmart out at 62.76. So let's take a look. I'm going to take a look at some of these in real time. Just give you guys an idea of how I'm going to look at things during the day. Wait, where did my 620 chart go? Let me give me a moment while I straighten things out here, please. Okay. Here we go. Pull this out. Make that nice and neat. Bring this down. All right, let's look at Walmart here. On the 620 chart, you can see that you've been rolling around. The 6 and the 20 have been kind of tussling together, you know, like they're making love, as I like to refer to this. But you can see now we're getting another 620. So I'm watching this. I'm putting out a little bit more right here, 6298 on the bid. So just put out a little bit more, another 2,500. So if it keeps rallying, I'll put it up probably to the 20-day. If it busts through, then we're looking at possible intraday resistance closer to 63.50. But this is how I'll work a short. And if it doesn't work, I'll back away and I'll come back at it. So let's look at Nike. Now Nike, you know, basically you have a cross here already on the MACD, and as you're pushing higher, you're trying to come out of this range, but now you've rolled back over. So I'm shorting into this up here on this rally off the opening, and then adding on this rally here, and just kind of playing with it a little bit. So, but I'm now that it started to come down, I'm actually hitting it heavier. So we'll see what happens from here. You're at 58.50. My average cost right now is 58.66 on the total position. So I'm tracking that against the current trade against my average cost, and I can see whether I'm up or down on the position. Right now I'm slightly up. Let's look at First Solar. It's another one I put out earlier, and this is pretty much a no-brainer. Once I saw, now this is where I was smart, and that I was long Solar Edge, and I unloaded it right at the opening because I didn't like this, and you can see the big bar here on First Solar. I didn't really, you know, it opened up and immediately just sat there. I didn't see anything come in. It started to come in. As soon as it started to come down, boom, I'm gone. And at the same time, as I flipped out of that, I went short First Solar right at the 50-day, around 64. And shortly thereafter, we got a 620 sell signal, so I pump it again and double my position there. And now it's continuing lower. Well, my target would be at least these lows, somewhere above 57. Short term, we'll see where it goes from here. Maybe it stops me out. I don't know. But for now, I can use the high of the day either at the 50-day or the high of the day at 64.83 as a guide for a stop. So that's how I'm going to handle those. What else? Amazon. Amazon was pretty much a no-brainer. Right at the opening, let's see, 6:30 is my time. Right at the opening, it flashed a 620 sell signal, and it was right at the 20-day line. I've been watching Amazon for a while. And it was right there, so just boom, hit it there with a decent sized position. And I'll trade this one in for like 500 share blocks. because it's a $500 stock. You see Tesla's starting to roll over. So anyways, those are things I've shorted. Here's Tesla. You can't borrow Tesla, but you can buy puts on it. So you can see it also had a 620 sell signal right at the opening. And flipping through this, in the first 5 minutes of the day, I could quickly see that everything is flipping out on me. So my longs were gone and I started shorting. And what you'll notice is that when a follow through fails, it tends to fail very quickly, such that if you're seeing at the same time as follow through day, a lot of the stocks on your short sale watch list hitting potential areas of resistance, and they start to reverse. So in other words, I'm seeing a lot of 620 sell signals early in the day, and that's what we saw not too long after the opening. To me, that's real-time evidence that I can discern, that I can see, and that I will react to. And I'm not going to sit there and fight the market on the upside trying to hold longs. I'm just going to flip and go short just like that, and take my long profits for 2 or 3 days worth of a rally and watch for a follow-through day failure. Because if you do fail, a follow-through day failure can be one of your more profitable turning points on the short side, and we're seeing that today so far. So I've got I think prospects are decent for a pretty nice day on the short side. So far, it's not too bad. But when we see the market down, Nasdaq down 50, 60, 70, the Dow down 100, 200, then talk to me about how much money we're making. So in the meantime, it's a little bit touch and go. Anyways, that's really all I have. So hopefully you guys are getting some insight. We went through my entire short sale watch list. On the long side, I don't know, names that Facebook, I told you was one trade I made. Microsoft's another two. These were like 2-3 day trades. You see other names like Smith & Wesson. We looked at that last week right along the line here, and that actually has gone higher, and it's acting well, but it's guns. Gee, I wonder why. And then you have Hawaiian Airlines, which is breaking out. Of course, you had to buy it along here. I think we looked at this last week, and it's moved higher, so that's a decent trade. Other than that, the long side is pretty grim. There's these little tiny Fabrinet, as a gap up, it's moving higher, and it's in the same, roughly similar type of business. These are suppliers of lasers and optics and stuff like that, and they all look the same. Momentum is another one, and then there's this Oclaro. Sorry, I always want to call it Ocular. But they all look the same. That's kind of work. The Cree is kind of work. So I'm watching all these things as they pull back. I may flip back to the long side, bag some scalps on the short side, and then flip back to the long side. But that's what this market is. It's a short-term trader's market, and I think that's why last week I recommended you guys read Richard Wyckoff's book, My Secrets of Day Trading, I think it's called. Do I need to look at that again? Let's see. Make sure I get the title right. Is that right, Dr. K? Did I give him the right title on that?
Say that again?
Is it My Secrets of Day Trading or my? I've got it here. Give me 1 second.
I think it's
My Secrets of Day Trading in Stocks. That's it. Anyways, and it's dated because you talk about if you have an account, you want to use a broker who has access to the floor. Now that doesn't matter at all. And they're talking about stocks trading at 1/4 and 1/2 and 3, all that stuff. And of course, that's all old and quaint, but it's fun to read. Sometimes I wish for the days when we traded at teenies and 8s and 1/4s and 1/2s. So there's something more romantic about it, digitizing everything, or what do they call it? Decimalizing everything. While everything is digitized, it's sort of taken the romance out of it. As we know, that's why the high-frequency trading funds are now most of the trading that you see, the trading volume. Anyways, I think that's all we've got. I don't have anything else to add. So, it's pretty concrete. Some things I'm watching on the short side, some on the long side. As they pull back, I'm remaining flexible. It's still a short-term market in my view. I don't think you're developing some bold new bull trend. You're basically in the midst of a second leg down in a bear market that started in the middle of last year. And whether we're going to get into a bear market rally or not remains to be seen. So I think it's just a matter of watching the real-time action. We've gone through my short sale watch list, so we've got a good sense of that and where everything lies, and we'll just see how things play out. So anyways, for the most part, I think if you're a nimble trader you can be in this market. If you're not and you're looking for a trend, you're probably better off just hanging back in cash and waiting for things to set up again, because they will eventually. So anyways, that's all we've got. You got anything else, Dr. K?
Yeah, no, I think I think we've said it all. You know, just expect the market to remain volatile. These levels of elevated volatility, I think, are going to be part and parcel of this bear trend. If you go back to, say, 2000 to 2002, we had elevated volatility through all those years. I think the VIX tend to average in the 20s, which was up from the teens back in the 90s. So I would not be surprised to see that elevated level continue from here.
All right, very good. Thanks for showing up. You guys, will catch you next week, and good luck.
Take care.